To build anything that truly lasts, it takes time.
It was a stellar quarter for Paytm for the quarter gone by. The fintech major reported its first operationally driven profit since listing, aided by strong growth in lending and drop in its expenses. Paytm also announced changes in its board of directors. The group CFO Madhur Deora to retire as executive director at the next AGM. My colleague Varun is joining us with the earnings fine print and how the quarter in general looked by for Paytm. Varun.
Well, so the quarter has been very good for Paytm because the company has delivered its first ever profit of around 123 crores, and also the EBITDA. I'm talking about the absolute EBITDA and not the EBITDA before ESOP, because before the company used to report the EBITDA before ESOP and that was profitable. Now the EBITDA for the company has also turned profitable. Around 72 crores was the profit, the EBITDA that the company has reported, and the margins of the company came at around 4%. The company also said that going ahead the company would report a profit, the EBITDA growth of around 15 to 20% going ahead for the next 2 to 3 years, and also till the end of this year the overall margins of the company is also expected to improve going ahead from the 4% margin that the company delivered in this quarter. If you look at the valuation of the company, the stock currently trades at around 5.2 times FY27 sales and around 21 times FY27 EBITDA. Brokerage houses have been mixed on the overall results for this company. If you look at brokerage house like Jefferies, they have actually upgraded the stock from hold to buy and have raised the price target from 900 to 1250. Citi also has a buy call on the stock. They have also raised the target from 975 to 1215, and also BofA has raised the target on the stock. But if you look at Macquarie, they still have an underperform call on the stock with a price target of 760 rupees, and CLSA also downgraded the stock from hold to now reduce, although they have raised the price target from 870 to 920. So brokerage houses are basically saying that the overall results of the company are good. The company did what they have promised, that they have come in profit, but yes, majority of that is still in the price, and that's the reason they have actually raised the price target but actually reduced the overall rating on the stock. So it's a good story for Paytm. The company is in profit, but if you look at the performance of the stock price, it has been a roller coaster ride for Paytm. From the IPO price of 2150, the stock went down to 400 levels and it's back to 1000 levels. But yes, you still have a perfect bull versus bear case for Paytm, wherein someone says yes, it's time to buy, but some says that it's all in the price.
Okay, Varun, thanks for that. So, well, the street is out on what the next action regarding Paytm should be. And before we discuss that with our expert, let's listen into what the management had to say about the quarter gone by, especially the recovery that they've seen in personal loans.
It is not the agenda. It is rather investing in a few more line items that we believe are long-term growth. So we are not actively pursuing cost cuts, while I'm definitely pursuing whatever is not necessarily drop it out of the window. Where we are, obviously, if you read the earning release, we have pruned out every word which included EBITDA before ESOP, PAT before ESOP, or anything before ESOP. Next quarter onward, we will stop giving the ESOP line and it will be only the employee cost, so that we are maturing towards absolute complete employee cost, including EBITDA or PAT, where the ESOP cost is a cost to the management. So there we go. No more adjusted anything.
Okay, that's a take coming in from the management at Paytm. But let's connect with Gurmeet Chadda, the managing partner and fund manager at Complete Circle Consultants, who's here to share his view on some of these new age companies. And Gurmeet, hi, welcome to ET Now Insight. First up, give us your sense on the numbers that we've seen for Paytm. Paytm is back to black this time around, but brokerages are still flagging off some concerns. What's your take?
Yeah, hi. With the disclaimer that we don't have Paytm in the portfolio, I think 2-3 things I think are encouraging. One, I think their payment devices continue to do well, whether it is sound boxes, different sound boxes, or merchant machines. So if you see the quarter on quarter, there's a growth in sound boxes, there's growth in merchants they have acquired. Although the payment revenue is flat at roughly about 1,000 odd crores, I think the market would have been happier. And what it does is when you grow your payment business, you can leverage it to do loan. They have this daily EMI kind of a concept, right, which you can collect from the digital payments the vendor gets. So they are leveraging the payment business to increase the loan portfolio. I think where the profit also improved was that, so there are two types of loan you do. One you do with this without default loss guarantee. It is called DLG. And then one loan you do where you have to give some kind of a DLG to the lending partner. In last quarter, one of their largest lender actually allowed them to do non-DLG cases, which means they had to do lesser provisioning. Also tells you the asset quality is improving now for the loans they disburse. So I think if they are able to leverage this part well, continue to grow the payment business and leverage this to get, better revenue on the financial services, because the market is still underpenetrated, there could be some runway. But we do not have currently, as I said, any exposure to Paytm. And I think market would want to see this kind of metric quarter on quarter before, actually developing a much stronger view on the franchise. Also, they lost a lot of people previously with host of issues they had with RBI. So they're also rebuilding the team. And in banking and financial services especially, the team and the culture is extremely important. So that will also depend in terms of their ability to build back the team because they had massive attrition in the payment bank and the financial services vertical.